What does it really mean when we say bull market or bear market? These terms aren't just financial buzzwords. They represent the overall mood and direction of the market, like a weather forecast for investors. A bull market refers to a period where prices are rising or are expected to rise. Think of it like a strong, confident bull charging forward. In this scenario, investors are optimistic, driving demand and prices up. Historically, a bull market is characterized by a 20% increase in stock prices from recent lows. For instance, during the long bull run from 2009 to 2020, the S&P 500 index saw remarkable gains, fueled by low interest rates and strong corporate earnings. On the flip side, we have bear markets, which signal a decline in prices and a generally pessimistic outlook. Picture a bear swiping down with its paw, pushing prices lower. A bear market is defined by a decline of at least 20% from recent highs. This can create a downward spiral as fear sets in, causing investors to sell and further driving prices down. The financial crisis of 2008 is a prime example where panic led to significant losses across the board. But here's the surprising part. These cycles aren't just about numbers. They reflect collective sentiment. When people feel good about the economy, they invest. When they're anxious, they pull back. Understanding these trends can help investors navigate their decisions, revealing the underlying psychology of market movements. So in essence, a bull market signifies rising confidence and prices, while a bear market reflects declining sentiment and value. Recognizing these patterns is crucial for grasping how markets operate. If you've learned something new today, consider subscribing for more insights into the world of finance. What does it really mean when we say we're in a bull market? Imagine a plane on the runway, engines roaring as it prepares for takeoff. That's how a bull market feels. It's all about rising prices and soaring investor confidence. In a bull market, asset prices climb by at least 20% from their recent lows. Think of it as a sturdy aircraft gaining altitude. Just like a plane leaves the ground, investors start to feel more optimistic, believing that the economy will improve. This optimism drives more buying, pushing prices even higher. You see, when people think the market will keep climbing, they buy more stocks, which creates increased demand. This cycle continues, with more investors jumping in because they don't want to miss out. It's a bit like a snowball rolling down a hill. It picks up speed and size as it goes, fueled by that positive sentiment. But here's the surprising part. It's not just about rising prices. A bull market can also be characterized by strong economic indicators, like low unemployment and growing corporate profits. These factors reinforce that sense of confidence, making it feel like the market can only go up. Investors often become more willing to take risks, pouring money into new ventures, believing the good times will last. That's what makes a bull market feel so exhilarating. It's a collective belief that the sky is the limit. So the next time you hear about a bull market, think of that plane taking off, soaring higher and higher, driven by the confidence of all those on board. What does it mean when we say we're in a bear market? Picture this. A plane that's supposed to be cruising at a high altitude suddenly begins to descend. That's what happens in a bear market, where prices drop by 20% or more from recent highs. The mood shifts from optimism to anxiety, and investor sentiment feels shaky. Let's break that down. In a bear market, the fear factor looms large. When investors start to believe that prices will continue to fall, they may rush to sell their assets to avoid further losses. It's like passengers on that descending plane. Everyone's feeling uneasy, and the instinct is to get off as quickly as possible. Now, here's the surprising part. This fear can create a feedback loop. As more people sell, prices drop further, which triggers even more selling. Imagine a snowball rolling downhill, gaining size and speed. This cycle can push markets down even further than expected, sometimes leading to a prolonged downturn. So what's behind this bearish behavior? Economic indicators play a huge role. Rising unemployment rates, declining GDP, or negative news about a major company can cause investors to panic. It's like hearing turbulence in that plane. Suddenly, the comfort of high-flying profits seems distant. Importantly, bear markets don't last forever. Historically, they're often followed by recoveries, just like that plane eventually finding its ascent again. Understanding these cycles helps investors navigate the emotional landscape of the market. So, in summary, a bear market is characterized by a significant drop in prices driven by fear and negative sentiment, creating a cycle of selling that can lead to deeper declines. And next, we'll explore how these market conditions impact investors and their strategies. How do economic indicators shape our understanding of bull and bear markets? Think of economic indicators as the weather forecast for the financial landscape. Just like a sunny day might prompt you to head outside, strong economic data can encourage investors to buy into the market. During a bull market, we often see low unemployment rates and rising GDP. Picture a bustling cafe where everyone is happily sipping coffee. When people have jobs and incomes are rising, they feel secure and confident. This optimism translates into increased spending and investment. Businesses grow, profits rise, and stock prices follow suit, creating a self-reinforcing cycle. It's like a snowball rolling down a hill. The more the economy grows, the more investors are encouraged to jump in, driving markets even higher. But here's the surprising part. When we shift to a bear market, the mood changes drastically. High unemployment and an economic slowdown can turn that sunny cafe into a ghost town. When people lose their jobs or fear for their financial security, they cut back on spending. Businesses start to falter, profits drop, and investors become wary. This pessimism leads to selling, which further drags down prices, creating a feedback loop of negativity. So the real difference between bull and bear markets is not just in the market prices, but in the underlying economic indicators that influence investor sentiment. Understanding these indicators helps you see the bigger picture of market dynamics. Recognizing how these factors interact can deepen your grasp of market movements and prepare you for what lies ahead. Curious about how other elements fit into this puzzle? What drives the relentless cycle of bull and bear markets? The answer lies in investor psychology. Think of it like a roller coaster ride. In a bull market, investors are the thrill seekers, fueled by excitement and greed. Just like when you're at the top of that first big drop, the adrenaline rush makes you want to buy more. You see prices rising, and that can create a bandwagon effect. Everyone jumps on, convinced that the good times will keep rolling. Here's the surprising part. This behavior isn't just about numbers on a screen. It's deeply human. When stocks are climbing, the narrative shifts to optimism. News outlets highlight success stories, and social media buzzes with tales of quick gains. It's like everyone is at a party, sharing their wins, which only encourages more buying. The collective mood becomes infectious. Fear of missing out, or FOMO, takes over, and investors are eager to join the party, often ignoring risks. Now, flip to a bear market, and you can feel the mood shift. The atmosphere turns heavy with fear and uncertainty. Imagine a group of friends at a party, suddenly realizing the music has stopped. Investors start selling off their assets, not wanting to hold on to losing positions. News coverage changes too, focusing on failures rather than success, feeding into that fear. The cycle can become self-reinforcing. As more people sell, prices drop further, causing even more panic. So while economic indicators set the stage, it's the psychology of investors that really drives these market trends. Understanding this emotional landscape is crucial for making sense of market movements. And the next time you hear about a market shift, think about what the mood is, because that's where the real story lies. How can recognizing the difference between bull and bear markets empower you in your investing journey? At its essence, understanding these market phases is like learning to read the pulse of the economy. In a bull market, optimism reigns supreme. Picture a wave building up at the beach. As investors become more confident, they buy more assets, driving prices higher. This cycle of rising prices feeds into more enthusiasm, creating a self-perpetuating loop where everyone feels positive about the future. For example, think of how tech stocks soared during the pandemic. As more people relied on technology, investor confidence surged, pushing prices to new heights. But here's the twist. A bull market can lead to complacency. When everyone is riding high, it's easy to ignore the signs of an impending downturn. That's where the bear market comes in. Picture it as a sudden storm rolling in. The atmosphere shifts, and fear takes hold. investors start selling off their assets, causing prices to decline. This negative sentiment can spread quickly, much like a rumor at a party, leading to more selling and further price drops. Now that you understand the dynamics of both markets, you can approach investing with a clearer mindset. Recognizing the emotional drivers behind these trends helps you make more informed decisions, whether you're riding the wave of a bull or preparing for the storm of a bear. Ultimately, this knowledge is your compass in the often unpredictable world of investing. If you found this clarifying, consider subscribing for more insights.